Ever wondered what really drives the stock price? Is it the hype? Is it the analyst predictions? So hello everyone, I am Tamandeep and today we are going to answer that very simple question. Yeah. So today we are going to answer that very simple question. But before answering that, let's ask ourselves a much fundamental question. What even is a stock? You see, we tend to forget that stock is not a lottery ticket. Stock is a part ownership of a business. You see, part ownership of a business. And now think like a businessman. What is it that you really care about? Is it how good your shop looks? It's not, right. All you really care about is money, profit, rokda. That's what a businessman cares about. Similarly, when the earning increases, the stock price will follow it eventually. But why eventually? You see, in short term, stock price can go up down because of the hype or of the just general enthusiasm of the public, right? But in long terms, stock price will always follow the earning. So let's see that with an example. So this is Infosys. This is in USDs, yeah. So in late 1990s and early 2000s, it had a consistent earning growth of 30 to 40%, which it continued over the years. And see how beautifully the stock grows over the span of about 20 years. And yes, it takes that much time, right? Early success is a myth. We are here talking about solid principles. It takes time, but it will reach a great height. You can see that. But what happened here? It seems a bit suspicious. Anyhow, let's move on. And similarly, if the earning is going down or is stagnant, no hype can save it. Do you remember Yes Bank? It was such a good stock. Everyone was buying it. It was rising really good. But they were actually in lows. And when that bubble burst, we all know what happened, isn't it? Look at this. It was rising so well and it fell so hard. People did not have time to take out their money. It fell that bad. Yeah, that's what happens. So, is that it, guys? Is that really that simple? Did we just crack the stock market here? I wish it was that simple, but it's not. Before moving ahead, let's study a little theory. I know, but bear with me. Success requires hard work, yeah. So a little theory is required here. PE ratio. What is PE ratio? PE ratio is the price of a stock over the earnings of that stock. Right. Think of it like this. The number of years the company will take to earn back your initial investment. So let's go down to the basics. If the price of the stock is far higher than the earning line of the stock or the company, it will fall, right? It makes no sense for the price to be much higher than the earning line. So this ratio helps us to see that. So let's go back to Infosys example, shall we? So we were talking that this seemed suspicious. Let's enlarge it a bit. So now that we have enlarged it, we can clearly see what happened here. It was rising well and then it fell. But as I told you, during that time, the earnings were increasing and pretty good, right? 30 to 40% per annum. So what happened here? The same thing, the hype was too much. Earning line was good, but the price line was way ahead of the earning line, right? The PE ratio was much higher than what it should have been. And the stock fell. And that's what happens, guys. So be careful about it. So what should the PE ratio be? Some people say that PE ratio should be equal to the earning growth per annum. But I say don't get into that. I said the best way to see PE ratio is to compare it with its peers. If the general PE ratio of that industry is same as that of the stock, then it's okay, it's a fair buy. If it's the general PE ratio is higher, then it's a good stock. Just look at its peers. That is the best way as far as I am concerned. Yeah. So this brings us to our final most important point. See, when you are buying a stock, what you are actually buying is a future earning potential. Right? See, you are investing in a fast grower. You are investing in that thinking that in the future it will earn really well. It's growing really good. But because of that, you will find that PE ratio of such fast growers is usually very high because investors are willing to pay that much more price for the stock. Isn't that right? So, because of that, I can say even the best companies can be a bad stock. So, what do we really need to think? Whenever you buy a stock, you need to articulate a story. And in that story, ask yourself these questions. Is the earning growth as expected? Is the PE ratio attractive? Is the product or the merchandise attractive? And will the company keep growing? And once you buy a stock, revisit the story once every few months. So guys, tune out the noise, ignore the small fluctuations, and focus on what really drives the stock price, that is earnings. So that's it for today guys. See you later. Bye.